In this video, we're going to talk about Triland Equity Investor Funds and how they utilize a unique investment using either a letter of credit or a pledge agreement instead of a cash investment. So how does this actually work? Instead of investing cash up front, investors can use assets like a bond or stock portfolio as collateral. These letters of credit or pledge agreements are then pooled together to secure an acquisition line of credit used by the fund to buy our grocery-anchored shopping centers. Let's break it down with an example. Meet Joe, an investor who's new to the fund and has a $1 million non-qualified TD Ameritrade account. Joe would like to be able to invest $500,000 with a pledge agreement using this account. The initial investment requires a 2-to-1 coverage ratio so that Joe has adequate coverage for market swings. Ameritrade would provide the control agreement identifying which accounts Joe is pledging for this investment. Joe would also need to maintain an account balance of at least $600,000 or 1.2 coverage ratio during the 2-year investment period. If his account falls below that threshold, Joe may need to add additional collateral. The good news is that Joe doesn't need to sell any stocks or bonds to make this investment, nor does he need to borrow any money. With the pledge agreement, Joe can keep his investments and also invest in Triland Equity Investor Funds, earning returns from both. Let's say the fund buys a $10 million shopping center using this acquisition line of credit. Joe would use about $350,000 of his pledge agreement. From here, Joe would start earning a commitment fee and a return on equity fee as defined by the private placement. If he earns $21,000 over 6 months, that's about a 12% annualized return, creating additional yield for his stock portfolio. It is important to know that Joe only earns a return as his pledge agreement is utilized by the fund, but he's always staying invested in the market. Once the shopping center is transferred to the development fund, about 6 or 12 months later, a distribution is made for the fees that Joe's earned, and his pledge agreement utilization is back down to 0. In addition, Joe also owns 5% of the residual net profits when the development fund ultimately sells that shopping center. Now, the fund may utilize this line of credit again if within the 2-year timeline, or all the pledge agreements will be released if it is at the end of the fund. That's the gist of how a letter of credit or a pledge agreement would work in the Triland Equity Investor Funds.